Let's start now. We will keep the questions till the end of the session because we're running out of time, and we are going to. We have a lot of topics that we have to cover today, and the most important thing is again understand. We're going to use today's free session is to identify our risk and to quantify it based on the premises of price behavior, and again, everything in based on price behavior is mainly psychology and understanding how the market trades and how the money is made. So, trading as a whole is a business of risk. Some guys were here was somebody was saying that he's a floor trader, and I'm sure he understands this more than anybody. Is that the key is they trade big size, they trade thousands of contracts a day, and the reason they are able to do that is that they are able to control the risk. I will give you everything, guys, at the end of the session. Okay? So, in order to trade, we have to have a mature and a good understanding and respect of risk. And trading is nothing than a business of risk. We transfer risk between one trader and another all day long, and that's what traders do. Okay? And the whole market is developed is to move risk from one trader to the other. There are traders that trade price, and these are the ones that the companies and the speculators, these are the ones that transfer the price risk, whether the price is going to go up or down on the long term from the producer or the manufacturer to the traders, and these are the ones that are known as speculators or long-term traders. And day traders are the one that trade on liquidity, or they're looking for and that's the short-term traders that are trading the availability of the liquidity, if you will, we call it. These are the short-term traders that are trading liquidity, and the arbitrageurs are they are the ones that are trading from one market to the other. Okay, so the essence is we have to understand the long-term trader where he is. Have a seat, Mike. Have a seat here. The long-term trader where he is buying and selling and where he's going to assume to accept the risk from the hedger or the producer, and where the short-term trader that is trading the liquidity or trading the price, where is he going to make his decision. So we have to understand what the price is, and if we understand the price, then we can understand the structure or the reasoning behind the identification of risk by the trader, and we will be able to pinpoint our points on the chart, because when we are trading on the chart, the key is to identify these price points, and these price points are our decision making points, and I'm going to show you that in a second. So what is a price? I mean, for some of you who have attended the previous seminar, I'm just going to repeat that. The price is basically nothing more than the collective perception of the traders that are trading the instrument. If we believe that, if the collective perception believe or the traders believe that this is a good price for them to buy, then they are willing to buy it or to pay, to bid the price higher so that they can convince the sellers to sell what they have in order for them to buy it, and that what will put the price higher as they will be bidding the price up. In this case, the sellers are demanding a high price and the buyers are willing to pay that higher price, and that will push the prices higher. And the vice versa on the market. Okay, I'm sorry. And is this better? And if the market is coming down, if the traders are not willing to pay the current market price, and they are demanding to buy it at a cheaper price, and the sellers, oh, and is this better? Let's test the sound again. One, two, three, four, five. Okay. And if the sellers are willing to accept a cheaper price, that means they are offering it at a lower price, then the prices are going to decline. Okay? So again, it is the now once a trader gets into the trade, the first and the most important thing he decides is how much he's willing to risk on this trade and how much he's willing to to accept as a loss, or where he will define a point on the chart where he would say that this is as far as I'm going to let the prices to go against me to get out. And in this, the traders behave always in the same way, especially if they are in a bad situation. So if a trader is making a poor judgment, then he'll behave in a specific way. If he's not making irrational decisions, so he is now in a bad trade and he's losing money, so usually his decision making process will be rather irrational. And traders at the majority, they make a poor assessment of risk. And once they get caught in a bad situation, they will try to get out as fast as possible. And in this case, they will be paying the other side of the market in order to get out of the bad trade. So let's say we are short and the market is going up against us, then they will pay the market. They will pay any price the market is demanding, that they will have to get out of this bad short trade. So our success as traders is in our ability to understand how these emotions affect the price action and where can we see the stuff on the chart. It is not enough that we understand. I mean, we have to have a good understanding, but if we cannot pinpoint these locations on the chart, then we won't be able to take advantage of us. The floor trader, like the gentleman, I think Doug was talking on the earlier, that he was a floor trader, he was able to see the where the emotions of the trader by the volume of the sound. If he sees the pitch going higher and he's already long, then this is he's going to sell it, and the vice versa. He usually trades based on volume and understanding of what the other floor brokers are doing. But once you get off the floor, you lose that pitch, you lose that volume, and you're unable to communicate. So now we take this knowledge and transfer it to the chart so we can see where the pitch is getting louder, where the noise is getting higher, and where the traders are going to reverse and get out of this of their trade. So these emotions will appear on the charts and we will be able to see them. Now, if we understand this, this is what's going to give us the edge. So let me go to TradeStation because and then I will repeat. I will tell you. All right. So let's put the TradeStation on. 1 second. So what we are trying to do is we are trying to look at the chart so that we can identify where traders are going to buy and sell and how we are going to identify our risk. So as I said, there are three types of traders that are trading the market. There are the day traders or the short-term traders as we perceive, and there's also the long-term traders. So for each, there is a level of risk or a parameter of risk. Okay. So now we are going to start as the most important level of risk or the most important decision making process that the traders look at the chart is that we have to define for ourselves a point where traders make a decision and where a traders will realize that they have made a mistake or an error of judgment. So looking at a chart like this, and if I'm coming into the market, first thing if I'm coming into the market and I'm looking at a chart like this, the most important point for us to identify our risk and to decide where we are going to go out of the trade. Some traders today, or the majority of traders, do several things today. They choose or they define their risk by what they call a stop. And traders, in using a stop, most of them use what is known as a money stop. And these guys would say, I am willing to risk, let's say, 20 pips on a trade, and that is my risk on this trade. That's one way of doing it. The other way of doing that is what we call the technical stop. And that means you define a point on the chart, a location on that chart, and that location would be your exit point. The third kind of a stop that we need to be taken is what's known as a time stop. And a time stop is once we get into the trade, we are going to allow the trade to mature for a certain period of time before we can make a decision to get out of the trade. These three kinds of stops or three kinds of elements for us to decide our risk on the trade vary, and they are different. If I am looking at a money stop, if I want to identify the importance of these three types of stops, I'm going to show you now how we quantify them in a minute. I'm just explaining them now. The first stop, if I say I'm going to take a money stop of 20 pips or 30 pips or 40 pips. The second stop is I'm going to pick a location. So let's say I'm going to say, if I go long over here, if this is where I'm going to go long, I'm going to put my stop below this location over here. So this is my entry. This here is my entry to go long, and this here is my stop. Okay, so that is a technical location. I identify a point where I'm going to go long, and I identify a point where I am going to exit the trade. Now, the money stop by saying 20 pips, this is not your best kind of a stop. You are not supposed to choose a stop solely on the amount of money that you're willing to risk. We cannot say I am going to risk 20 pips and that's good enough. Do not do that. Why? Because the volatility, it's arbitrary, and because the volatility of each instrument is different, and the minimum move it does swing here is different from one currency to the other, then you're not, if you use, so for example, if I'm having my entry over here, if you look at these two lines, between the green line and the yellow line over here, you would see that this move, this is from 149.95 to 149.46. You have about 50 pips on this average swing. I mean, this has been oscillating right there within a range of 50 pips. So if I put a 20 pip stop, then the odds are I'm going to get stopped out. So you might as well write a check to the floor broker and give him your 20 pips and walk away and save yourself the headache. Trader Doc says consult the ATR. That is brilliant. Now, if you just want to take a money stop, then I would suggest for you to go and take the average true range, and you should, and again, I want you always when you're trading and using indicators just to use the default numbers. Do not optimize these numbers. This one here says 14. Use the 14. The optimization of a stochastic and a movie and a MACD from, let's say, a stochastic from 12 or whatever 14 to, do not change these numbers. The guy that created this has found that these are the default numbers and these are the best, so use them. So in this case, use the 14 period moving average. And right now, based on this chart over here, at the time of my entry, if I put the time of my entry, so at the time of my entry, my average true range is 96 pips. So if you want to take a money stop in this case, your money stop should be at least the 96 pips. Anything less than that is going to be too tight and is going to be arbitrary. Okay? This is if you do not use the price structure, if you do not use the chart structure, then your best option is to use the money stop. Okay? Hold on a second, guys, please. Hold on a second, Charlie. I will answer all your questions. Give me a second. I don't want the computers have crashed. My PowerPoint is on the side, and I'm just doing this live, so I don't want to lose my track of thought. Will you please? So I'll open it all for a question. Okay. Now the second thing you want to be doing is what we call the technical stop, and the technical stop is based on location on the chart. And this, guys, is the best thing that you can identify is identifying what we call the price structure. And based on the price structure, you can identify an exit or a location where you are going to exit the trade. So I'm just going to go somewhere over here, and I just moved the chart haphazardly somewhere so that you can see right there. And I'm going to walk you through the process of identifying a structure or a location where you are going to. Now, the best place to place your stop or choose a location for your stop is what we call a momentum low or a momentum high. Okay, somebody would say that is, we can call this support or resistance. Support and resistance, any price point, any price bar, the high of that bar is resistance and the low of that bar is support. So if I put any bar chart, the high of that bar chart is resistance and the low of the bar chart is support. So when we talk about support and resistance, we have to talk about it in a better understanding of it. Okay? So you want to be looking at the chart like what we see over here, and you want to place your stop above and below what we call the momentum highs and the momentum lows. You want to have an explosive move, that you see that big range explosive move, and if you are going to go short, then your stop is above that momentum high. And if you have decided that you are going to be a buyer somewhere over here, then your stop should be below what we identify as the momentum low. Why do we do that? Because momentum is the essence of a directional price move. And when it reaches a high point, this is where, especially after a momentum, and for example, I will explain this to you, Doug, in a second, because I think you can appreciate that. After a big momentum move like this is where the market stops to go any higher and it rolls over and it comes down. If I'm going to explain this in a floor broker terminology, a floor broker or a floor trader would buy something and then he is waiting to see the volume of the other traders come in and they are all screaming at the top of their lungs, buy, 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 buy. And as soon as he hears the pitch has gone so high beyond a specific point, that floor broker, because his time perspective is small, he will actually sell at the pitch, at the high pitch. When the pitch of the noise gets so high, to him, that is the top, and this is where he's going to sell and capture take his profits. So when we are trading, you're going to use this visual here by putting ourselves in the position of the floor broker, and we want to see that pitch get louder and louder and louder and louder and louder. And once it stops getting loud anymore, it starts coming down. This is where the pitch has been loud enough where they have decided they are going to take profits and the market will decline. So above that high pitch, we are going to place our stop, because also for another reason. Once the floor brokers are selling, the floor traders are selling it when the pitch goes high, they are going to take their profits on the long, and they will also try to sell it to go short to take some profit on the downside. They, as professional traders, they trade in risk. They deal in risk. They have already, all of them have identified that this is the highest pitch. I'm going to put here the highest pitch right above that high. And they have gone short. Now they have taken their profits and they are going short. So they now have identified that this, let me see what the price is, the high pitch price, that the high pitch price is 150.34.9. So what they will do is they will put their stops right above, let's say they'll put their stops above 150.40. So they are going to go short and they will have their buy stops at 150.40. And that's what the floor traders or the floor would do. Is that once they reverse their position and go short, they will be putting their stops on the other side. So that our understanding of their behavior, that's why we should put our stops with them. And these are all buy stops. If the prices will come back up above the 150.40, then that price is going to explode to the upside, because all the traders now are going to buy back their short positions and they are going to reverse and they are going to go long. So let me show you this in a live. I mean, I picked this spot on the chart haphazardly, but I want you to keep an eye at this price point, which is 150.34. And I want you to see if the prices, I'm going to move it to the right, and we will see if the prices go above the 150. So as you see right here, this is where it came to where the pitch was loud, and so far there has been the floor brokers did the same thing at what they have done before. So after that big explosive momentum move, as soon as the prices came back again to this point, this is where they have stopped. And I want to see if it goes above it, what happens. There was a reversal this time. Okay, this here might be a good example right there. Okay, So this is, if it gets above, as I said, the pitch high, this is where we are going to initiate, they are going to reverse. So by the same token, we're looking at, as I said, a momentum move, and at the extremes of those momentum, we are going to place our stops. So this is here my momentum low, and that tells us, okay, I'll explain it, Abel, in a sec. If you want to put a location, a stop on the chart, the idea of putting stop and support and resistance is not, in its classic interpretation, is not enough. Okay? You need to identify the support and resistance that is followed and by momentum. So you want to look at the chart at the biggest explosive move, like this one here. Okay? And these are the two locations that you are going to place your stops above and below. Every point on the chart, if somebody tells you support and resistance, that is not enough. Every high and low of a 5-minute bar is support and resistance because it stopped. It resisted from going higher and it turned around and came down. That is not enough for you to place your stop. You have to look at an explosive move like this, a big move. This is here from 149 to 150. That's a 150 pip move. That is an explosive move. So you want to be, whether you're going to make a trading decision here, if you want to buy or sell. If you wanted to buy, then your stop should be here. Okay? If at 149.80 you wanted to sell, then your stop should be right there. If it's too big, we are going to get into quantifying the stop later. Now we're identifying our exits. Now later on we're coming to the quantifying aspect. And keep in mind that, and it's very important to identify these momentum points, guys, because they will give us a tremendous money-making advantage. So right here, I have buy stops, and these are for the ones that went short, okay? And right here, I have sell stops. Now, the rule is this. This is one of our price behavior rules. It's one part of the 21 rules that we are going to trade. And the rule is this. I'm going to write it here. M stands for momentum. Momentum highs are meant to be bought. Momentum lows are to be sold. So now you identified the two momentum points, and we have now, if whatever I'm deciding to do over here is fine, but once I have, let me clarify. So right here, I'm going to make a trading decision. I'm making a trading decision where I have the question mark. Okay? So I'm making two decisions, guys. Some of you were asking me about risk reward and stuff like that. I'm going to put the whole picture together. So right here at the question mark, I'm going to make a trading decision. Some of us will buy and some of us will sell. And that's what makes it a market. For every buyer, there is a seller. So let's say here I decided to sell. Let's say for whatever reasons I decided that I'm going to sell. So I'm selling. I identify that right here, I'm going to come, again, it's material. This is a big, let me finish this. Right here, okay, let me answer so that the professionals, and you cannot really define that on the chart, Mirko, okay? It is practically impossible. but we want to define the pitch. We want to define where the majority changes bias. And the majority is after a momentum move. So after a big momentum move, you know that the amateurs and the professionals and everybody that's trading the market has reversed. And that is sufficient information for us. But right here, there is nothing here. In this area, there is nobody. But I can say that right here, there was a big majority of traders. And right here, there is a majority of traders. So just follow with me here the process of identifying our risk, quantifying our risk, and then making a trading decision so that we can make money. So bear with me for 5 more minutes, okay? So right here, I am decided to sell. So as a trader, I am taking what I'm supposed to do, taking the high probability trade. The second thing I have to do is to identify and quantify my risk. So if I decided to go short at 150, I have to look at the momentum high, because above this I'm going to put my buy stop over here. And that buy stop is going to give me it's going to give me 2 decisions and not 1 decision. If I'm selling at 150, I am buying at 150.40. That's 1 decision. What is the second decision? The second decision is the rule of price behavior is that momentum highs are meant to be bought. So if I made here a decision to go short for whatever reason, we're not doing trading now, we're doing risk. If I decided here that for whatever reason I'm going short, I identify that my risk is 150.40. That is my exit risk. And then 2, the second risk I have is I'm going to apply the rule of price behavior, that if the prices do come and trade right there and my stop is triggered, then that momentum high is meant to be bought. So I need to close my short over here and to reverse and to go long. If I decided over here that instead of selling, I am going to buy, okay, then if I'm going to buy, let me put the buy here so that you can see. Again, the buy is at the question mark and the sell is at the question mark. If I decided to buy it over here at 150, my stop here should be at 149. So if I go long, if I buy over here, my stop has to be 100 pips from 150 to 149. If I go short, my stop, I'm going short at 150 and my stop is 30 pips. Even though it's the same pair, it is the same currency, at the same time I'm taking the trade. If I go short, my stop is 30 pips. If I go long, my stop is 100 pips. And the second decision is, if it comes below, if it trades below here, then I'm going to close my long position and I'm going to reverse and go short. And the reason I'm reversing and going short is that because this is a momentum low, not just a support. And if I sell it over here, then my stop is above the momentum high. And if the prices go above the momentum high, then I am going to go to reverse and go long. Okay? Now we have identified the risk. We have identified how many pips I should be putting on the stop. Now, another question would arise, and I'm going to show you how the trade develops. Let's see how the trade develops, and then we're going to come and quantify the. So let's see how it works. So let's say we have taken a trade, and now we have our plan. We went long. and the market is moving sideways, whatever it is. And this, let me put a line so that you can see. I want you to see that. I'm going to put a line over here, and I'm going to give it a different color. It's going to be a solid line. So I'm going to put this magenta line, and I'm going to make it a heavy line so that you can see what I'm talking. This is the line here. And I'm going to put also another magenta line on top, because these are going to be our decisions. Anyway, so if it comes below the magenta line, I am going to be stopped out of my position, my long position, and I have to go short. So we are going to go short if it gets below 149, and I am going to go long, reverse and go long. If it gets above 159.23 right there, I'm going to guys, supply and demand and all that kind of stuff, this is fine and well. Anything in the market is supply and demand, okay? You can, again, these are different names people give it to make things look supply, demand, support, resistance. Well, these are all names. You can call it any way you want to call it, okay? I will come back, and I don't know what the rest of the questions are, so write it again. But anyway, going forward, you can see that the prices came to the right here to the momentum high, and it did not go through it. So we might have been stopped out, but we did not reverse. Okay? Now the prices are coming down. Let's say we are long, and the prices now is coming down. Our stop is below the 149. I'm going to show you quickly. So our stop right there, you see this is where we had our stop, guys. We wrote this is where we're having our stop because this was the momentum low. As soon as it breaks the momentum low, and that was the stop, this is where I am going to sell to get out of my long position, and then I am going to apply the rules of price momentum or price behavior, that momentum lows are meant to be sold, and you, in this area here, we have lost. When we went long at 150 and we came down to 149, we have lost 100 points. So if I had one contract, I lost. If I had one contract, in this case right there, I lost $1,000. But it might be a big stop. We will discuss that in a minute. But right here, as soon as the prices come at this point, I got stopped out and I lost $1,000. If I do nothing, I will still end up losing $1,000. But if I do work based on a methodology and a set of rules, and I know exactly where I'm going to reverse, then even though I lost $1,000 over here, I am going to go short because that's the rule. Momentum lows are meant to be sold. I will go short at the 149. And that is your move, guys. It took you all the way down to the 146. So even though, and this is a live chart, I did not make up this presentation. I just showed you right now following the set of rules. So if you shorted, you lost $1,000. Now you made $300, $3,000, and then you can recover your losses and you make up the additional profit. And that's why you always have to have these kinds of rules, because if one would lose at a trade, if one would take the loss on every trade and does not take the following trade, he would always end up with the losing position and then will not make it up. Okay, Doug, give me 2 minutes, Doug. I will answer your question. Absolutely right. The idea when you say that, he has a good point. He says that not every time they, when they break the support, they do not crash. Okay? Uh, the idea, and that is one of the biggest mistakes that traders fall into, because they cannot differentiate. Hold on, guys, let's not have it. He has a valid point, and I am trying to clarify it. I mean, Doug has a valid point, Arcox, so let me explain it to both of you. You are both are right. The idea is, for example, if you take, exactly, Sheena, if you take, hold on, guys, I will answer all your questions, please, but let's not, if you take just a regular support and resistance, Dog, okay, then, and I will show you right here on the chart, let's say here, let's say those areas over here, look how many times it comes and stops and it bounces and it goes up. That is a difference between taking a momentum low and a momentum high, Doug. I only said if it breaks below a momentum low, then you go short, and if it breaks above a momentum high, you go long. So here, there is no real momentum move. I mean, all what you need to do is to see and look at the chart. And Sheena, you are correct, because after momentum, you begin to get structure. If there is no momentum, you don't have structure. So the chart is like, it's again, the structure of the chart is like the structure of a building. You have to have a column so that you can build the roof. And then once you build the roof, you put the second set of columns to build the second roof. Okay? In the chart, that column that we build on top a roof is the momentum. So if I don't have momentum over here, I don't have structure, nor do I have a reversal point where I stop and reverse. You stop and reverse, Doug, below a momentum low and above a momentum high. And if you do not clearly see a momentum structure on the chart, then you do not take the trade. Okay? So right here, we have identified, look, for example, here, this is the 149.46. Somebody would say, yeah, I can go short here and make money. That wasn't the trade where we went short at. We went short not at 149.46. We went short below the 149.12. It's not even appearing here on the chart. It is the prior momentum low that we have pinpointed over here. And that's why we have our software identifying the momentum lows and the momentum highs with a green line and a red line, and then we extend the lines, these momentum with a dashed line, so that if they get hid or they are hidden by the chart, then we know where we are going to place our short and take. So right here, you take the short and you take it down. Okay? All right. We have now the one more thing about the risk in this case to quantify it. As I mentioned to you guys that in this case, going short, your stop is 30 points, and going long, the stop should be 100. Now, one would say that, Mike, if I'm going to lose $1,000 on this trade, that's too much for me. I don't want to take a trade that I lose $1,000. Well, fair enough. I agree with you. But here is the point. The point is the technical stop. This is 1,000, or it is equal to 100 pips. So you have to put the minimum stop. If you want to do the right thing, you have to take the stop of 100 pips. Now, it is up to you to decide how much would be the cost of the pip. You want the pip to be $1, so you can take a mini, $1 a pip. You can take a mini, and that means you put 100 pips, and that will be $100. If your test appetite is $300 on a trade, then you can take 3 minutes. At least you have given yourself a chance to succeed on the trade and to make the correct trading decision. So you can say, I'm not going to take this trade. This is 100 pips. It's too much for me. I'm going to let this one go because it's too big a risk. That's one option. The second option, you can cut your size down to where your risk appetite matches your dollar risk appetite. So if you're risking $200, then you take 2 minutes. This means it is equal to 200 pips. Or the third option is you say, okay, I am not taking the long because I'm not willing to put that. But what you have done by going through the process is you have identified your momentum low. Okay, lovely, sure. Then you have identified your momentum low as 149.12. So you might say, I am not taking the long, but if it gets below the 149.12.6, that is the momentum low, then I'm going to hit it with the short. Once you go through this process, that identifying these momentum highs and lows where they will give you the entry, they will give you also the ability where you are going to reverse. Okay? So, and as you see, if you took the trade from that momentum low, you would have seen how successful this trade would have taken you. Now you have about 350 pips on the trade. You'd have made up. So either you would have made 250 pips on this move if you took the long and you got stopped out losing 100 pips, or if you refrained from taking the long and you only took the short when it broke below the momentum low, then you would have made 350 pips. Okay, Doug is coming today with all the brilliant questions. Then we will come back and give you a brilliant answer. Hold on, guys. Hold on. One thing at a time. Now, Doug, since you are right here, when we go short, guys, here, when we decided to go short here, Doug is asking me a question. We decided to go short at below 149.12. Do you agree with me on this, Doug? That was the reason we got into the trade? Because we followed the rule that momentum lows are meant to be sold. We are pressing. If you're a floor broker, you know that once it goes through that level, everybody is smashing it down. Right there, if it goes through that momentum low, do we have any reason? What is the reason for us to go short? We went short only for one reason. It is a momentum low. It broke through a momentum low. It's a breakout of a momentum low. That was the reason that we went into this trade. So this means what? You're asking me now about the stop. So if the prices are, after it breaks over here and it starts, after it breaks over here and starts coming down, the only reason we went short is it because it traded below 149.12. So if for whatever reason the prices come and trade right here above our entry point, do we still have a reason to stay short? No. We have no reason no longer to stay short. And that's why those big, you don't guess. There is no guessing. In this case, once you have a breakout of momentum and you have a breakdown like this, the guessing game is over. You are going to put your stop above that momentum low. And these momentum trades, guys, are the ones that gives you the best stop, the smallest stop, and you can take it to the biggest reward. Okay? So if I have now, if I'm going to go short below 149, let's say 12, and what you need, guys, is this. Let me show you what you need so that, hold on a second, this is very important. Where are we? Quick, I'm gonna go. Now, once we have, I want you to, hold on, guys, please, Jazz, wait for 2 minutes because this is a very important point. I want everybody to understand because if you take this from today's lecture, that is good enough. Okay? Hold on a second. Now, we have decided that we are going to go short below the momentum low, which is the 149. This is our number here. This is our number here. We decided that if it gets below the 149.12, we are going to go short. Okay? Now, we need evidence. We need evidence that we are right. That this, Doug was saying, sometimes it goes down and it reverses back up. How can we know it is right? Based on price behavior, this means that, or human behavior, if this was a true momentum low, exactly, Sheena, you're learning. Sheena is one of our favorites here. Exactly. You need that follow through. You need the price action to confirm to you that you're on the right side of the market. So if 149.12 is a momentum low, if 149.12 is where all the sell stops are sitting underneath, so if the prices is pushed below 149.12, you expect to see what? Capitulation. You expect to see all the orders of the stop market orders are being triggered, and that is now your confirmation that you have made the correct decision. You get the confirmation from the price action. You get the confirmation from the chart. You have decided that your reference point is 149.12. If it breaks with this capitulation, then you're on the right side of the market. That is all the evidence you need. Now you stay, you know you're on the right side of the trade, and you take it all the way down. Okay? And that's the importance of having these momentum lows and momentum. And even if it comes above the momentum line, and your stop should be just a few pips above the momentum low where you put the stop, because the only reason that you got into the trade is because it broke below the momentum low, and that's why you put your stop right above that. Okay? So, and for example, here is another example. This is this morning, guys. This is this morning. This is today. If you would have just, again, as I'm showing you live charts, I'm not making any of this. It's not a PowerPoint presentation. I don't like to give PowerPoint presentation. I like to show you this stuff live on the chart. So take a look here from yesterday. This was yesterday, and this is the pound yen for anybody that is looking. As you see, is this a momentum move, guys? Is this a big move to the downside? Absolutely. So now here I have an entry to go long above that momentum high. Yes, I will wrap it right now. And if it gets below that green line, then I have, that's my momentum low. I'm going to take it short. And that was your plan from yesterday. And coming into today, as soon as it breaks the momentum low right here, you initially go short. And as of this morning, you're up 1,000 or 150 pips on that trade. Okay, guys, we are wrapping up. So thank you very much for this.